Heyo, it's your boy coming to you. I know you're used to seeing me behind the wheel. We're playing it safe because we got a serious conversation on our hands today. With me, Mr. Jason Scott, Jay Scott, and it's great because I was just sharing with Jason. If you don't know Jason, he's a published author. He is the head of the business podcast for Bigger Pockets, coming to you live from an undisclosed location in Florida. Good afternoon, Jay. How are you, brother?
Hey, Dave, and not really undisclosed. I'll give you my address if somebody wants to drop off Christmas cookies or something. I'll give them my address.
And the reality is, I'm not that important. Hopefully, we get a few viewers. But I met Jason actually through the Freedom Founders Network. I saw Jason speak, and then we became Facebook friends. And then shortly after we became Facebook friends, I said, "Wow, there is a guy who likes to debate on Facebook and kind of call people on their crap, even more than me. And he's actually he's more well spoken than me." So this is my first time actually meeting Jay face to face, and it's a great pleasure. And this guy's going to bring some good stuff. He's got a lot of good stuff to say. So first off, Jay, how are you?
I am doing well. It is gorgeous here in sunny Florida and just got back from Denver where it was cold and snowy. So I am happy today.
It's cold in Ohio. What part of Florida are you in?
I'm in Sarasota, so Siesta
Okay.
Key,
Very
kind of
nice.
west coast.
So Jay does a lot of real estate investing, everything from he's done a ton of single family homes, lending, borrowing, apartments, multi-family, commercial, the whole kind of deal. Give us the quick snapshot of, through your perspective, the real estate market right now. What's going on?
Yeah, I think, well, real estate's always local. So what I say isn't necessarily going to apply everywhere, but I think in a lot of parts of the country, what we're seeing is a really inefficient market. We're not seeing, typically when we talk about markets, we talk about efficient or inefficient, and efficient kind of means you got a whole lot of buyers, a whole lot of sellers, and everybody has a ton of information about the market. So they're making informed decisions. When you talk about inefficient markets, you're talking about not as many buyers or sellers and people not having enough information to make good decisions. And what I'm seeing is we have a somewhat inefficient market in a lot of areas. We have just as many buyers as we normally would have. People are still buying houses. In fact, a lot of people are moving out of cities into suburbs. People are moving from high tax areas to low tax areas. People are moving from places that were hit hard by COVID to places that weren't hit that hard. So tons of buyers out there. But where we're seeing the lack of supply is in the sellers. I know in my market and in a lot of the markets that I'm in, we're seeing a really constrained supply. So Sarasota, Florida, just as one example, year over year, we tend to see X amount of listings this time of the year. This year, we're down about 25%. So why is that? It's not that people don't want to sell their house. It's that here in Florida, COVID's been pretty bad, and there are a lot of older people, and there are a lot of people that are terrified to like list their house because they don't want people just trouncing through their house, and because they're worried about COVID. They don't want to have to leave their house every time there's a showing because they're worried about being out in public because of COVID. And so there are a whole lot of people out there that are thinking, I'm just not going to sell my house right now. I'll do it when we have the vaccine, or I'll do it when COVID goes away. I'll do it when I'm more comfortable. And so we have all these buyers. So we have a lot of demand, but we don't have nearly as many sellers. We have a constrained amount of supply, and supply and demand. When you get a lot of demand and not a lot of supply, what happens? Prices shoot up.
And then you throw in historically low interest rates, and everybody's chomping at the bit.
You throw in historically low interest rates. You throw in the fact that there's a ton of money out there. You throw in that there are a ton of us investors out there that are looking to pick up deals. And yes, you have even more demand, and you still have constrained supply. So prices are just through the roof. So I think as we see COVID kind of subside, as we get through the winter, as we get more to a vaccine, as people get more comfortable, I think we're going to see more supply. We'll probably still see a lot of demand, but I think we'll see a softening in the market, and we'll see either a leveling off or maybe even a decrease in prices. I'm not saying it's going to be a 2008 sort of thing or a Great Depression sort of thing, but I think we will see a softening in the market just naturally when all the supply comes on the market.
Not to mention, I just heard Mr. John Burns, the economist and consultant to a lot of the big home builders, their new construction's on fire.
Absolutely.
It's new construction spreading faster than COVID at this point. I mean,
Yeah, I think there are a lot of people who a year or two ago thought, okay, we're heading towards, like, there was some indications that we were heading towards not necessarily a recession. I'll say it. There were plenty of indications that the economy was starting to slow down. I think home builders started to slow down, and then here we are in COVID, and there's so much demand for housing that these home builders got spun up over the spring and the summer, and now there's a ton of new housing starts. There's a ton of new development, new construction. So, and I think a lot of that, I mean, we know new construction, you can't just say I'm starting today and the houses are ready tomorrow. I mean, it's generally 12 to 18 months lag between the time you start applying for permits, you break ground, and you actually release housing. And so I have a feeling that come a year from now, 12 months from now, even 6 months from now, for the stuff that started 6 months ago, we're going to start seeing a lot more housing supply. So not just people that are looking to sell their houses because COVID's over, but a lot more new construction. So I think that's another thing that's going to contribute to massive supply over the next few months, and is going to drive a softening in the market.
Another thing that I just thought of, and I didn't have this thought before, but you triggered this for me. Construction costs are also extremely high right now.
Yeah.
And the builders are still able to get their margin because they're able to sell these homes at a premium. Yep. Because of the low interest rates. People can afford more house. I wonder if and when more supply, and I know neither one of us is saying there's going to be a rush of supply on the market, but I wonder if, as supply tends to increase, if the builders' margins are going to get compressed if that construction cost remains high.
Yeah, I think it is. And a lot of times we look at the difference in the cost to rebuild a house versus the cost of buying a house that's already on the market, basically a resale versus a new construction cost. And typically, as new construction costs get much higher than resale costs, existing inventory costs, typically what we see is a slowdown. Because there are a lot of people that no longer have new construction as an option for them. And so now you have a whole bunch of people that are competing over existing inventory, not considering new construction because it's just too expensive. And that's another constraint on supply. And so then you have a lot of people where then prices start to go up and there's affordability issues. And yeah, there are all these competing forces. When you talk about the economy, that's what the economy is. It's all these competing forces. And when people say, yeah, nobody has any idea what they're talking about, nobody really knows where things are headed, it's not that we don't understand why things happen. It's that there are so many competing forces that we never know when one is going to kind of get stronger and one's going to get weaker, and when one force is going to overcome another force. And so that's why the economy and housing is so difficult, is because we understand each of these pieces in a vacuum, but we don't know how they're going to interplay with each other and how each of these forces is really going to play out.
I'll share another that just came to mind, another competing force, which is different this time around. Rather than 08. You can't really compare right now to 08. That was all driven from the, ninja loans and subprime mortgages and whatnot. Now, which is different, which is really interesting. And we're seeing this in our market. In fact, we actually sell to these entities, but the single family asset class has become a tradable asset class on Wall Street now. So you got these giant funds who are not only gobbling up as much housing as they can, if they can still get it below new construction cost, they'll gobble all that stuff. So they're actually like paying what we consider in my market here in Ohio, retail prices for stuff that still needs work, which is kind of crazy, driving the market up. But also build to rent is a major play right now. And it's been that way for several years, but it's really, really ramping up. Are you seeing that in your, what you're dealing with?
So it's funny because where I am is there's literally thousands upon thousands of new units coming on the market and under construction. And a lot of that is build to rent. We actually just bought some raw land over the last few months that we're waiting for the counties to put in public sewer and water infrastructure so we can do some build to rent. So I'm definitely seeing that, not just from the hedge fund standpoint. So the the big hedge funds that are coming in and buying up literally thousands of units and building thousands of units. But even mom and pop investors are starting to realize that there's some opportunity to buy land and build and then to hold on to that for cash flow because rents are kind of pushing up as well with prices these days. So if you can build relatively efficiently, there's great opportunity for that build to hold investment strategy. Whereas over the last few years, that really hasn't been a very viable strategy because build costs have been so much higher than rent.
Let's talk about another major competing factor that we just barely touched on, but interest rates being at an all-time low.
Yeah.
And Jay Powell from the Federal Reserve has inclined, that they're not even thinking about interest rates or raising interest rates. But I think anyone who's been in the space long enough knows that never believe anything that the Fed says. They're, full of crap half the time. And quite frankly, they don't know what they're doing. They're clueless on many, many things. But what's your take on interest rates? We're at an all-time low. Do you think we'll see an increase in interest rates in the next, say, 24, 36 months?
So let me start with, I think no. I think we're at low interest rates for the next 3 to 5 years. And there are two big reasons for that. Number one, yeah, I absolutely agree with you. Don't believe anything the Fed says, but do believe what the Fed is trying to do. And when they tell you they're trying to do something, there's a saying where the Fed typically gets what they want. And so we've heard over the last couple of months that the Fed is pushing for more inflation. We've had below average inflation over the last couple of years, probably 1.5%. And we could argue, I think, if we really dug into it, what we would find is we've actually had pretty high inflation. But if you go by the government's numbers for inflation,
CPI, well, that's a joke, though,
yeah,
as you know.
Yeah, it is. But if you look at the government's numbers, they would tell you, yeah, we've averaged about 1.5% inflation. The government has said over the last couple of years, we want to target 2% inflation. Sure. And then about a month and a half, 2 months ago, Jerome Powell came out and said, not only do we want to target 2% inflation in the future, we want to target average 2% inflation. And what that means is to get to the average 2, when you've been averaging 1 or 1.5, to get to the average of 2, that means you now need to target 3 or 3.5 or 4%. So basically what the Fed is telling us is they want more inflation. Whether that's a good thing or a bad thing, we could argue all day, but the fact that they say they want more inflation and the fact that the Fed typically gets what they want, it's probably reasonable to assume that we're going to be targeting more inflation. So what does that have to do with interest rates? Well, typically speaking, there's this inverse correlation between interest rates and inflation. When you lower interest rates, you speed up the economy and you get more inflation. When you increase interest rates, you slow down the economy and you get less inflation. And in fact, that's really the whole purpose of the Fed playing around with interest rates, is that they're trying to control inflation. So if you believe the Fed when they say they want more inflation, the best way for them to actually get that is to keep interest rates low. If they increase interest rates, we're going to see less inflation. So if you really believe that the Fed wants more inflation, and I do believe that that's what they want, I think they have to keep interest rates low. The other reason I think we'll see low interest rates is that interest rates play into how much the government has to pay an interest on the bonds that they're issuing, the debt that they're taking out. When the government prints money, they're not really just printing money. They're actually selling bonds. And so somebody's actually backing that money by buying bonds. And typically the price of those bonds, the interest that those bonds play, is going to be related to interest rates. So if interest rates go up, the government's going to have to pay more on these bonds, on the money that they're printing. They're going to have to pay more interest. And government doesn't want to pay more interest, because paying more interest on all this money that they're printing and all these loans that they're making is going to hurt the economy. So the best way to keep their interest payments low is to keep interest rates low. So between those two things, between basically the government wanting inflation and the government not wanting to pay ridiculous amounts of interest because they can't afford it, interest rates pretty much have to stay low. And until the government decides that they're okay with less inflation and they're okay paying more interest, I think we're going to have a low interest rate environment.
There's good and bad to be said, about inflation. As far as we were talking a little bit before the Facebook Live, and how inflation is actually good for businesses and consumers, and a moderate amount of inflation, not hyperinflation. Yep. One of the bad things we didn't really touch on is what inflation does in like a K-shaped recovery and creating the haves and the have-nots, right? Can you touch on that a little bit?
Yeah, this is something you've been talking about for a while, and I think a lot of people may not have heard about, except maybe through you. But I have a feeling over the next several months, this is going to kind of come into the common vernacular. This idea of a K-shaped recovery. We typically talk about the economy goes up and down and up and down, and we have these cycles, this sine wave sort of looking thing. And right now, the economy is wherever it is. I mean, we could argue about whether we're at the top or the bottom or the middle, but typically the recovery from there is either going to go down or it's going to go up, or eventually down and eventually up. But a lot of people are talking about this K-shaped recovery, which means that instead of the entire economy going down, or instead of the entire economy going up, like we typically see in a cycle, what we're going to see is we're going to see for some people, the economy goes up and things improve. And for other people, the economy goes down and things get worse. And that's kind of where this K nomenclature comes from. So if you think about a K, starting from that middle point, there's a line that goes up and a line that goes down. And certainly we want to be on that line that goes up. We want to be that part of the world where things are getting better and we're making more money and our businesses are doing well and our investments are doing well. But for a lot of people, that's not going to be the case. I think a lot of people are going to be in a situation where things get worse. And so what's kind of going to drive whether you're on the upwards line of that K or the downwards line of that K, a lot of it's going to depend on where you're starting out. And for people that have debt, for people that are working a 9-to-5 job that aren't generating their own income, for people that don't have cash flowing assets, for people maybe that are renting and are reliant on other people for their housing, what they're likely to see is that kind of all the things going on in the world are going to conspire against them, and it's going to make their financial situation worse. For the other half of the population, those that have cash flowing investments, those that have their own business, control their own fate, those that may have a reasonable level of good debt and no bad debt, for those people that own their own homes, where things are typically going pretty well, what they're going to find is that the economy is going to conspire for them and it's going to help them. And we all know, I mean, we've heard these stories about people like Jeff Bezos, the founder of Amazon, who has essentially added literally $100 billion to his net worth, and how these billionaires over the last 6 months have added a total of about $1.5 trillion to their net worth. Clearly, those who are doing well are doing even more well throughout COVID. But we're also seeing that those who are doing poorly are doing even more poorly. Real unemployment is about 15%. The common measure of unemployment, the U3 number, is about 8%. We have more people who are not paying their rent than any time in history, but they haven't been kicked out of their homes because we have an eviction moratorium. We have more people not paying their mortgage than any time in history because government and the forbearances. Yeah. And so what we're seeing is there are a lot of people who are kind of on the precipice of really being in a bad position when the forbearances go away and the stimulus goes away and the rent moratorium goes away. And at the same time, there are a lot of people who are doing tremendously well because they've figured out how to take the stimulus and how to leverage the good things that are going on in the economy to kind of snowball that and create more wealth for themselves. And so that's kind of the long way of talking about this K-shaped recovery. But I have a feeling over the next year or two, we're going to see the rich get richer and the poor get poorer.
Without a doubt. And I was posting about that recently. You talked about some types of businesses, tech being one, with the stay-at-home economy and whatnot. And I don't know if we were live yet or if this was in our other conversation, but we're seeing a lot of people, and we're seeing it in our own business because we manage real estate, but we're seeing more and more people wanting out of the urban areas into the suburban areas. Yep. And really for the last 10 years, you've been doing real estate for a while. We've seen for the last 10 years so much regentrification of downtown areas and things like that. Now we're seeing people move out of these areas because they want out of the high taxes, out of the high crime, and they want space. We're in a post-pandemic era. We're still in the pandemic. People want pets. The desire for pets is at an all-time high. The price of pets is at an all-time high. So with that being said, what do you feel is a strong play for the next 5 years if we are having the discussion, if we don't think interest rates are going to go up, so let's just call it 5 years. What do you think a good play is in the real estate space for the next 5 years, Jay?
Yeah, so I'll say a couple things. One, you talked about people moving out of the cities to suburbs, and I
Yeah.
know I talked to some people who say this is going to be a permanent thing, and basically cities are never going to recover. It's never going to be the same. I like to think back to 2008 when millennials were saying we will never buy a house. Like, we've learned our lesson from 2008. We've seen our parents go through foreclosures and struggle, and we're renters forever. And everybody said this is going to decimate the real estate market because millennials, the largest growing group of potential home buyers, is saying they're never going to buy a house. And here we are 10 years later, and who's the largest group of people buying houses? It's millennials. So people tend to have a short memory. So what I think what we're going to see is, we're going to see a lot of people move out of the cities into the suburbs. And I think we'll likely see prices in the cities drop. We're already seeing New York City, San Francisco,
Totally.
the condo markets are getting crushed. Some of the single family markets are starting to soften. Seattle's starting to soften. And so I think over the next year or two or three, we're going to see more of that. We're really going to see the cities taking a big hit in terms of housing prices. But if it's anything like 2001 and 2008, people are going to have a short-term memory.
Yeah.
And at some point, values are going to come down and people are going to say, wow, I can move back to New York City and it's cheap. I can move to San Francisco and it's relatively cheap. And people are going to forget about all the reasons they moved out. And then there are going to be people saying, let's move back in, and we're going to see the cities get redeveloped. So my guess is that there are going to be some opportunities for buying things like condos and single family houses in the more currently dense urban areas that are going to be less dense in the next year or two or three. And that's going to be a good 5 or 10 year play. The other thing I would throw out, we talked about inflation a little bit. Best hedge against inflation is debt. So if you see inflation coming over the next couple of years, we as real estate investors, we should be accumulating as much good debt as possible. I'm not saying go out and run up your credit cards. I'm not saying go out and buy fancy cars with loans. Good debt, get leverage, get loans against your rental real estate. And again, I'm not saying over leverage, don't 100% LTV, 90% LTV, get a reasonable amount of debt, because that's literally, you make money with debt when there's inflation. Because at the end of the day, inflation means things cost more, but it also means you're making more money at your job. You're making more money at your business. You're making more money from your renters because rent's going up. But you think the one thing that's not going up in price is those loans you took out. Your $1,000 a month mortgage payment will stay $1,000 a month for as long as you have that loan. So even though you're making twice as much money and your renters are paying twice as much money, you're paying the same amount on that loan. So getting good debt is literally the best hedge against inflation. So for any real estate investors out there, I would say now is the perfect time to be taking out loans at low interest rates for as long as you can. Don't do a 3 or 5 year loan. Take out a 30-year loan. Take out a 20-year loan if you can, because you'll literally make money on that debt as inflation increases.
The dollar is, I'm not going to, go all, Harry Dent on us and say the dollar's crashing but the dollar is, losing value. The more you print, the more it goes down. So you just got to think, a 20-year loan, the dollars that you're using to pay back the loan 20 years from now will be worth less than the dollars they gave you today to buy this asset, which is going up in value, and the rents are going up in value. So yes, it is a very good trade. I'm a big believer in the long-term low interest debt. I think it's the trade of the century. And last thing before we put a bow on this, it looks to be, nothing's final yet, but it looks to be like we are going to have a new administration taking office in Capitol Hill. What impacts are you seeing that are potential for the Joe Biden administration on the real estate market?
Yeah, I think certainly there are going to be things that as real estate investors. So let me start with, as real estate investors, as business owners, it's our job to be flexible, and it's our job to foresee what's coming and do our best to mitigate any issues and really kind of chart our own path, whether the administration coming in is going to be good for us or bad for us. So I'm not absolving us as investors and business owners of the responsibility to take our future into our own hands and be successful regardless of what the next administration does. But that said, I think the next administration is going to make things more difficult on us as business owners, as investors, as people who kind of take our financial lives into our own hands. I do think we're going to see taxes go up. I think we're going to see our marginal tax rates go up. It's very possible that we're going to see capital gains taxes go up. It's very possible that we're going to see some of the exclusions that we've been getting, like the stepped up basis and inheritance taxes, going down or going away. I know a lot of people are concerned about 1031s going away, and I personally would say that that would be a catastrophe for the real estate market if that happened. I don't think that's going to happen for the simple reason that those types of changes will have to go through Congress. And a lot of people in Congress rely on the 1031 exchange for to boost their network. And I think we're not going to see a lot of people in Congress that are going to vote against their own best interest to that extent. But I do think the Biden administration is going to push through some tax hikes that are going to hurt us. And so we need to be very cognizant about making sure that we're well positioned, that we're moving investments around so that if capital gains rates go up, that we can structure our businesses so that we're paying potentially more ordinary income taxes in some cases, which is a crazy thing to say, as opposed to capital gains taxes. If capital gains rates go up to 28%, there are a lot of us that are still going to be in the 20 or 25% tax bracket, and we might want to figure out how to move some of those gains to ordinary income as opposed to capital gains. And then in other cases, we're going to have to figure out ways around long-term exclusions of gains, and it's going to create some challenges. I'm not going to lie. And again, as business owners and investors, that's our job to figure out how to do that. But everybody needs to be prepared that over the next 4 years, I think we're definitely going to see an environment that's going to make things harder for us, not easier.
Without a doubt. Have you heard anything about a potential? And it's funny, I heard John Burns talking about it, and then I read it on Realtor.com about a $15,000 tax credit for new homeowners, first-time homeowners.
No, I hadn't heard that.
Keep that one on the radar. That could create even more, demand for houses, and everybody's a buyer. So if you're a flipper out there, get ready for a nice little run here. There's going to be plenty of opportunities. The biggest thing you got to do right now is be able to get your hands on some deals, since there's such little inventory. But that's what we do as entrepreneurs as well, is figure out how to get our hands on good deals. We'll wrap it up with this. You and I are involved in a small wager. It's a small wager, but a big deal now. And we are betting Mr. Corey Boatwright and Colin Andrews on crypto. And I know you own some crypto, and you've said that publicly.
Yep.
And you and I are taking the position of crypto. I think it's on January 19th or something, will be closer to 17,000. It's an over-under of 18.5, basically. So if it's under 18.5 by January 16th or whatever, we win. If it's over 18.5, closer to 20,000, they win. What is your position on Bitcoin as a whole, as a long-term play? And why do you feel it has not broke through that resistance yet of 20K?
Okay. So let's see, I'll try and keep this short. First, I am a huge fan of blockchain. Blockchain is the underlying technology that Bitcoin and Ethereum and all these other cryptocurrencies that people may have heard about is built on. And I am a huge believer that blockchain is going to be a technology that literally changes the way this world works and the way business works and the way transactions work well into the future. Blockchain is to today's world what TCP/IP, and people may have never even heard of TCP/IP, was back in the late 90s. And what TCP/IP is the thing that the internet runs on. It's the backbone of the internet. And even though you may not have heard of TCP/IP, you may not have heard of blockchain, you know that the internet has revolutionized the world. And so when we talk about Bitcoin today, it's kind of like talking about the websites that we were looking at back in the late 90s. And one of those websites was Amazon, became the biggest company in the world. Another one of those companies was pets.com, which we never heard about again. They were the biggest thing in the world back in 1998, and then it went away. And so you could argue back then, is Amazon going to do well? Is pets.com going to do well? Or all these other websites going to do well? And we could argue about that all day. The thing you didn't want to argue about was whether TCP/IP, the thing that the backbone of the internet, the thing that all of these websites were built on, At that point, it was pretty obvious that that was going to do well. And here we are 20 years later, and the internet has changed the world. I think you go forward 5, 10, 20 years, and what we're going to realize is the thing that Bitcoin and Ethereum and all these other cryptocurrencies is built on, the technology, this blockchain, is going to revolutionize the world. Then it becomes an argument of Bitcoin versus Ethereum versus any other cryptocurrency. Who's going to win? Who's going to lose? I think there's a good chance they all lose. I think there's a good chance that every cryptocurrency that's out there today, in 20 years, we will have never heard of again. Now, what's going to change that? What could make one of these a winner? I think one of these becomes a winner if some large government organization adopts one of these currencies or one of these technologies and co-ops it and says, we're going to make this the backbone of our financial structure, of our trading structure, whatever it is. Do I think that's likely to happen? Well, there's one or two cryptocurrencies, XRP, people may have heard of. Ripple is the more common name that has been adopted by a couple governments. But even that, I think long-term, I'm not betting on any cryptocurrencies. What I'm betting on is the technology that underlies the cryptocurrencies, and that's blockchain. So short-term, who knows? Bitcoin could go to 100,000. It could go to 1,000. It could go away. We're all just guessing. It's kind of like guessing if Amazon or pets.com was going to win back in the late 90s. Nobody knows. So I remember when we took this bet, I said, Dave, you pick which side of this bet I'm going to be on, because for me, it's completely a crapshoot. I would say that anybody out there that has a bunch of money and likes to gamble, sure, throw a % or 2 of your net worth into cryptocurrency or whatever it is that you enjoy investing in, because who knows? I bought Bitcoin back when it was $50. I bought Ethereum back when it was $12. I'm still holding some of it. I've made literally 6 figures in the last 5 years without even thinking about it on a couple $100 investment. Was I smart? Absolutely not. I was lucky.
Yeah.
So you want to take a risk, go buy $100 or $1,000 or whatever you're comfortable buying. It's a gamble. It's like putting your money on red or black on a roulette wheel. I know people that bought Beanie Babies back when eBay was big and made money because they gambled.
I still have my collection, by the way.
There you go.
I'm waiting. It's coming back.
There you go. So I don't recommend anybody buy Bitcoin or Ethereum or any other cryptocurrency as a smart, knowledgeable investment. But if you want to buy it as a gamble, which like something I've done, absolutely go for it. And then if you really like the space and you like blockchain, figure out a way to invest in these companies that are developing the technology, the underlying technology, as opposed to just the cryptocurrency, which is essentially the websites or the applications that are running on top of the technology.
I'll wrap it up with this. And, we can go on for so long, Jay, and you just got so much value, and you're just definitely the same fruit from the same branch, man. I mean, we studied the same guys and followed the same people and whatnot. But so I think the best play as well is if we had, $1,000, I would say save it, go make 19,000 more, and you put 20% down on a $100,000 house and rent it out. I think that's the play. So let's put that off to the sidelines, that we're not allowed to say that. So is there anything to buy right now? If you have $1,000, so let's say crypto, stock market, precious metals, is there, everything's pumped up right now, right? There's no good deals out there, is there?
Yeah. And so it's funny because we were talking about inflation earlier, and typically when we talk about inflation, people think there's this one definition of inflation. It's kind of like value of things go up. But really there's 2 different types of inflation that we tend to see. And one is this thing that you referred to as CPI inflation. And that's kind of the inflation or the price of everyday goods going up. Toilet paper gets more expensive,
gas.
And gas gets more expensive, and your rent gets more expensive, and your meals at a restaurant get more expensive. But then the other type of inflation that we often talk about is asset inflation. So things like collectibles going up in value, art and houses and investment property and gold and silver. And so a lot of times we see the 2 of them working together. When we see CPI inflation, we see asset inflation, vice versa. In this case, we've seen a whole lot of asset inflation. We haven't seen as much CPI inflation. And it's interesting because this ties right back into what you asked earlier about the K-shaped recovery. Who are the people on the upward branch of the K? Those are the investors. And what are they doing? They're making money. Jeff Bezos is making money, and Bill Gates is making money, and the real estate investors we know are making money. What are they doing with that money? They're buying assets. They're buying houses, and they're buying collectibles, and they're buying precious metals. And so what's happening? We see the value of those assets, those hard assets, going up. At the same time, CPI inflation is relatively low. We don't see the price, obviously toilet paper for other reasons, but in general, the price of milk and the price of butter and the price of food at restaurants is not going up in value, because those are the things that typically are being bought by the people on the downward side of the K. And so we're seeing kind of this dichotomy between these two types of inflation. We're seeing hard assets go up in value, and we're seeing commodities go down in value. Okay, so you were asking about what's good to buy now. I think buying hard assets right now, you should be pretty careful. If you're planning to hold it for another 5 or 10 or 20 or 30 years, go for it, buy it. It'll eventually go back up in value. I wouldn't have wanted to buy gold back in 2010 or 11, but here we are 10 years later, and we're kind of, if you would have bought it, you almost have your money back. And same way with houses. If you overpay for a house today, if you're going to hold it for 20 years and cash flow on it, you'll eventually get your money back, even if the market goes down. So what I tell people is buy good assets. Don't necessarily worry as much about the value of those assets if you're not planning to sell in the next 5 or 10 years. But focus on good assets.
I think the play is why we should go with bullets, Jay. Bullets. That's been priced in. I mean, I think they're going only up, especially if we get a new administration.
Well, I mean, certainly that's a good play right now, but we have a good capitalist society. And if people are buying a lot of bullets, we're going to have more companies out there producing bullets. And in a year or two, you might find that there are so many bullets out there that the bullets you paid for today are worth a whole lot less, because good, smart companies have gone out and started producing more bullets.
Especially not to cut you off with when COVID simmers down, production and the borders are putting up a little bit. That's what's driven the cost up as well.
Yeah, I like to buy those things that are much harder to produce, like houses. Houses are much harder to produce than bullets. Not saying bullets if you're looking, obviously, as a hedge. So if you live in a place where you're worried about your safety, you're worried about economic collapse. I'm not particularly worried about economic collapse, but I'm one of those people that recognizes that crazy things happen, and I don't lose sleep at night thinking that we're going to have an economic collapse and that I'm going to have people rioting and looting in my neighborhood. But we've certainly seen that in other places. And am I saying it could never happen? Absolutely, I'm not saying that. So for those people that are worried about that, go buy some gold. Physical gold, go buy some physical silver, go buy ammunition and weapons if you're comfortable with that. Because here's the thing, short term, the value of those things might go up when things get crazy. Worst case, everything gets back to normal and you're living a good life because the economy's back on track, and maybe you threw away some money on bullets and gold and whatever, but it's okay. You don't mind because the economy's doing well.
Jay, appreciate your time. You are a man of good sensibility, good debate, and I really appreciate you taking some time here today for myself and everyone in the crew, in the tribe here. Any final thoughts?
No, just go buy good assets. That's my final thought. That's the thing I wish somebody would have told me 25 years ago. Just spend my life collecting valuable assets. Don't think about what they're worth today or tomorrow. Just hold them for the next 10 or 20 years, because good assets will go up in value over the next 10 or 20 years. So for any new investors out there, don't get too hung up on whether I'm paying $20 too much today. Make sure it cash flows while you're holding it. And then hold it for as long as you need for it to go up in value, and just keep making the cash flow during that time.
All right, everybody. Mr. Jay Scott, look for him on the Business Podcast with Bigger Pockets, and just know your life matters. You do have a voice. Don't be afraid to use it. Hang out for a second, Jay. I'll be back with you in a second, but just know your life matters. You do have a voice, and don't be afraid to use it, especially if you are motivating, educating, or inspiring someone else. It's your boy Dave Pete with Mr. Jay Scott, and we will see you on the next video.